welcome to your Inner Circle session for this weekend today. I'm delighted to see you all here. And whether you're watching this live on GoToWebinar on YouTube or even watching the replay on YouTube, I'm delighted to see you here. Thank you very much for popping in today, where we do this probably once a month. We do a critical market update, just looking at the key things that are driving markets right now. Try to unpick them a little bit, of course, and we'll have a look at some charts along the way and talk about what could happen next as well, of course. Forearmed is forewarned, etc. is a key concept to bear in mind when you're trading or investing. And I hope to offer some thoughts on that. Of course, what is important in all of this is that you do your own due diligence on anything you see here. Make sure that you follow your own trading plans, your own trading objectives, and manage risk on every trading action. That's on entry and exit, consistent with your own personal objectives and financial situation. Thank you, as always, for just investing a little time in saying hello in the questions box. It's always really appreciated. Thanks so much to Wayne. Good evening to you too. My day was good, thanks, Keith. Good to see you here. Hi, Hugh. No worries at all, Brian. I hope we're getting there. Let me know how you go. Thanks for the heads up on the AV. Good evening to Shane, and hi, Sonia. It's always good to know that you're hearing and seeing me okay. Right, okay, let's get into it. And it's your session, so please feel free to comment, to ask questions. Always welcome. I'll do my best to answer them as quickly as I can on session. Anything I miss, I'll follow up with after the event. We usually do a last check. Good evening to you, Alyssa. It's been nice to be back on a time zone which enables you to pop into some more of these sessions if they're slightly later for you than you were until recently. To see you here. I did send you a message today, some light reading for you. Let's have a look at the session tonight and what we're going to cover. Really, the aim, as I've said, is to unpick what's going on for markets right now, so that you can sort of be in front, not behind, whatever happens and wherever possible. It's going to be a really interesting January. And of course, although the inference is that if you start January well, it's good for the rest of the year, that's not really, doesn't really hold up under any detailed scrutiny. Certainly there's inferences that can be made for the rest of the quarter, but it feels like such a lot going on at the moment, which could send markets back and forth. And of course, it's the interplay of factors, not one single factor, usually that it is important to keep an eye on. And it's these that create the sort of potential what happens next picture. So I'll do my best, as I said, to not only talk about three key individual things, of course, but also how they look together and what are the influencing factors they may be. So that's where we're at. As I said, feel free to participate at any time. Let's start with Venezuela. Obviously, this has been in the mainstream headlines really since the weekend, where we saw military action conducted in Venezuela. The sitting president, Maduro, was captured, taken back to the US, and is indicted. There's been broad geopolitical reactions to this. Let's start with the markets in terms of what happened since there was a surge initially in energy and defense stocks, as there often is with any conflict, and a surge in defense stocks. Energy moved forward, but not significantly so. But obviously, there's the potential for reopening of Venezuela's energy sector. There's no doubt that, and most commentators would suggest that the previous president wasn't some of his behavior, I need to put this not too politically and not too bluntly, but the success or otherwise of his dictatorship-like presidency was questionable in terms of its benefits to the Venezuela as a whole. I thought there was lots of alternative theories around this, but generally speaking, the fact that he's no longer president is not the issue here. The issue is the manner in which it happened and the motivations behind that. Initially, it was put in terms of a necessity from drugs spilling into the US, which is obviously a significant problem. But the reality is that Venezuela aren't a key player in that. There's the oil context, and Trump made no attempt to hide this at all in his initial conferences. And the desire for regime change, which again, historically, it's questionable how well this works. It's certainly, if we look at many incidences over the last few decades, it's rarely been what would be qualified as what would be described as a success. Anyway, the jury's out on all of that. So there has been a major oil transfer deal announced, approximately 30 to 50 million barrels of Venezuelan oil to the US at market prices. The level of control that the US will have over Venezuela and funds generated from that is again sort of up in the air. There's been inferences made by those within the administration as to what may or may not happen. There's obviously all sorts of questions about how Venezuela will operate. The vice president that was in place is currently interim. And the daily narrative seems to change about what might happen next. Obviously, one has made it quite clear that the expectation is that she will do what she's told. Otherwise, she will be removed also. And then there are various political risks. There are various risks. Certainly, if we look at the right in the US, this has not gone down uniformly well. Taking out the Fox Newses of this world that will without a doubt promote what happens to the right. If we look outside around certainly some of the right-wing influencers, there's been quite a debate. Certainly the disparity between Trump's promises pre-election of being a president of peace and not wanting to put boots on the ground on foreign soil in conflict/stroke military operations appears to be a massive disparity between what's actually happening. And this has been yet another thing where the significant discourse and disagreement on the right as to outside of the immediate cabinet as to whether this is consistent with what he was actually voted in to do or not. Anyway, it is what it is, and the dust will continue to settle before new dust is created. So it's a difficult one, and I hope I've expressed that without coming across as being too directional in terms of what should and shouldn't happen. What I'm trying to do here is describe what's happening, because what's happening will influence not only events right now, but potentially events later in the year. The midterms in the US are obviously coming up later in the year. And the feeling is that actions such as this are not contributing to potentially the Republicans holding on to the House or Senate, which is going to have major implications going forward. So that narrative, although not immediately impactful, is there. So as I said, there's modest moves in oil prices. There is a fairly abundant global supply being reported by OPEC Plus, and they've actually committed to increasing production. What this means in real terms is that Venezuela's output alone is not likely to shift the oil balance significantly. So that drop in supply isn't going to necessarily have such a supply squeeze that it's going to influence oil prices, pushing them higher. However, probably the major concern and the global response to this is the narrative around what may happen next geopolitically. Certainly already, it's been expressed that other countries are on the radar, like Colombia and Mexico. Two obvious examples. Greenland is in the crosshairs of Trump. He's made no secret of the fact that he thinks the US should control Greenland, not Denmark. And this is causing angst not only amongst the UN, but also the Eurozone as a whole. And generally that political instability, that there seems to be the rhetoric that the US has a right to. It is already the predominant force in the Western Hemisphere. But there is certainly some evidence that we may get a change in the way the world works. We've already seen that during 2025. Is this going to continue during 2026? The thinking is that, and certainly there is the feeling that this is moving towards a situation where the US will control that part of the world. Then we've got Russia controlling some of Europe already in terms of its incursion into Ukraine, which doesn't seem to get any closer at all to a resolution. And then China's dominance of Asia. So is the world order changing? Are we seeing things that are going to just accelerate during 2026? And that's what the concerns expressed are all around. So obviously it's not something we can make a judgment on now, but that's certainly worth keeping an eye on. If that makes sense. Somewhat disturbing, for sure. I agree, Brian. That there is when you get a country entering a sovereign nation and taking over, that is against against stated international law, and the fact that many have been critical of Putin into Ukraine, and then there's this situation here. It does appear to be disingenuous, sure. Anyway, we're more interested right now, right here, in looking forward to see what the risks may be, and all of what has been stated there, and that last point particularly, has got to be seen as a market risk, or at least a significant market influence over the coming months. But we shall see. But focusing back on markets now, it's really looking. If we look at oil price, let's do that. Let's look at some charts as we go. So there was two things we saw. So here's oil price. Let's say that's not particularly positive. And in fact, what we could argue is if you put this on a weekly chart, you can see there we're testing lows. You've got a descending triangle, so there's no influence positively on oil at all. These lows from February are actually lows not seen since now 2020. So the oil price, which generally would be volatile, quite choppy, and indeed quite bullish in times of conflict, is actually doing the opposite, which sort of reinforces that issue on supply. In terms of the markets as a whole, well, we're going to talk a little bit more about this later, but there's the US 500 daily at record highs. A little bit of a softness today going on. If we look at the futures generally, which we can do, then you'll see it's a little bit of a softer day all around. Perhaps markets are taking a breather, taking some risk off the table. But you can see there the futures are showing a mild retracement in equities, both in the US tonight potentially. The Europe's actually looking quite positive today, but we're seeing gold and copper and oil all pulling back a little bit, all because of the reasons we've already explained. Gold and copper, simply because they've had such an amazing run up over the last couple of days, or really since the turn of the year. But we'll come back to looking at these in more detail at the moment. So the picture is there isn't a market shock on equities overall. The markets aren't seeing an immediate risk in any way, shape, or form. We've got oil price, which isn't going anywhere. We have seen a little bit of flight to safety into gold. So you can see there that candle has pushed us up over, or these candles have pushed us up over the last couple of days. So there's a flight to safety going on that's supported to some degree by this flight to safety, but also the fact that if we look at the USD, it has gone up, but this is a good indication of a potential flight to safety trading precious metals. If we see the US dollar rising, as we do see during the course of the week, and precious metals going up, that's indicative of a flight to safety. So with both the USD and gold, let's just which we'll talk about in more detail later, near record highs. It'll be interesting to see what happens next. We'll talk about that in a few minutes' time, as I said. Rob asked, do I think the inflation in the US and Australia will drop? Inflation stop the gold run. Okay, so generally speaking, if inflation drops, and there's an expectation that that might influence central banks, particularly the US, of course, that we're watching, then the reverse is the case. A drop in inflation is likely to result in a drop in the USD. The drop in the USD is actually going to support the gold picture. We can have a quick look at interest rates if you'd like me to. The expectations are that the Fed won't raise rates in January unless there's some surprises in the data that's due to come out. I think it's the 14th from memory, but you can see here that the Fed fund futures are suggesting that there's an 84% chance of no rate cut in January if there is to be one. And this is the narrative in the press conference subsequent to that rate decision, which is right at the back end of the month, on 29th, I think. But you can see here that there's around about a 50-50 chance of a pause versus a rate cut. So that's going to be data dependent, particularly at least the jobs data as well, which is important this week, as well as inflation data. If we just click into the data, because we'll sort of reference this as we go through. There you go. There we go. There's Trump saying the money will be controlled by me. It says Trump. Okay, so we saw this softer than expected inflation number from in Australia, which was quite a surprise. We were expecting a move downwards, but that move is significant. At this stage, the expectation for before that number, the expectation for certainly Q1 was that the RBA won't move to the downside. And the expectation was that with strong numbers coming out relating to jobs as well, then the most likely next move from the RBA was up rather than down. But that could change the story. It'll be too early to see this on the right tracker, I suspect. But have a look at this tomorrow. See, up until when it was last measured, or when the rate tracker is last showing on the 2nd of January, the expectation was that 64% chance they'll pause when they meet next, which is 3rd of February, is it? Yeah, 3rd of February. I'm going to put this link in. Keep an eye on this tomorrow. Go and have a look and see how much that's changed in light of that inflation data. If indeed they've updated it, which they don't look as though they've done up to now. So there you go. That's what central banks are up to. But it is, um, it is going to influence. Central bank policy is going to be interesting again this year because again there's a slight disparity. You've got Japan, possibly Japan certainly, but Australia and the ECB possibly raising rates this year, or at best stay in a pause place. And you've got whereas you've got the US that are more likely to drop rates. It's priced in maybe certainly one, potentially two rate cuts this year ahead. So yeah, the impact on commodities may be significant. We'll come back to that. Let's move on to earnings season, of course, in the US, unlike Australia. We see an earnings season every quarter. In Australia, it's every 6 months. The last couple of earnings seasons have been very positive. Certainly the last one smashed out the ballpark over 80%. I think it was 82% from memory. Beat EPS expectations. 65%, I think, beat revenue expectations. So a very, very good earnings season. The S&P 500 earnings, and of course, a lot of this is priced in where we're at now. Estimates are approximately 15% growth in earnings throughout 2026. So remember, everything that's known or expected is already priced into markets. So this earnings season is really critical in terms of determining whether that is the case and whether current valuations which have priced that growth in are reasonable or unreasonable. The forward 12-month PE ratio for the S&P 500, 21.8. This is significantly over the 5 and 10-year moving average, which again always raises valuation questions. But much of that growth has been attributed to specific sectors, notably obviously tech during 2025, which is based on some fundamentals. It's not pure speculation, of course, but the fundamentals show that big tech, which obviously dominate market cap in terms of how much influence they have on the market as a whole. There has been questions raised over the AI space over the last couple of months, which is why we see companies like Nvidia have struggled fairly significantly. Let's just put an Nvidia chart on here. So here's a daily Nvidia chart. So if we look at where we were, let's say beginning of November, we're actually sort of around about the same place. So we haven't actually shifted much in the last 2 months. What's interesting, this is when there was 2 incidents when AI concerns seemed to be headline, but we were in a significant downtrend really for between October and end of November. It's only in the last month or so that we've seen buyers come back in. At this stage, we are waiting for something else. That's really the best way to describe markets now. We've got a resistance level on Nvidia at 192, and there's record highs. But you can see there, if we just put it on the weekly chart, how the performance was. And it wasn't until, as I said, it wasn't until sort of early November that we started to see some significant pullback in price. So, but we've recovered half of that already. So it doesn't look as though the market is keen to sell off completely. And so there is still expectations that will show good earnings and buying into tech. Communication services and healthcare are obviously sectors which have been identified as being potentially helping drive growth. However, the removal of the Affordable Care Act will have interesting implications, which was obviously one of the things that now appears to be under the radar. It'll be interesting to see what happens going forward with healthcare in the US. But that subsidy that essentially supported healthcare premiums has now disappeared. which means that people's healthcare premiums could double. And in a lot of red states as well as blue. So the impact of that on the consumer is potentially very damaging, and consumer confidence in the current administration is potentially damaging. But with the impact on healthcare companies is unsure. Obviously, if there's a lot of, despite the increased premiums, if there's a lot of people who subsequently can't afford healthcare anymore, does that impact on healthcare companies per se? Anyway, the jury's out on that, but we may see that reflected, or issues or more clarity on what the healthcare companies think during earnings season. Of course, the routine is we're told in terms of what performance was, what projected performance may be, and then there's usually a CEO press conference that talks about the details and the fundamentals, some of the fundamental drivers behind those numbers. Be interesting to see how healthcare companies do, or what reference healthcare companies do suggest that, and whether it impacts potentially on forward guidance. Now, as always, when we get to earnings season, it all kicks off next Tuesday, I think, with JPM, being one of the major banks, often the first to report. They kick things off, so it's imminent. And so, as always, what we'll be doing is looking at three things. We'll be looking at how did they do, what the forward guidance is, and that's going to be punished significantly if the forward guidance is uncertain. With some with the tariff implications, which are ongoing, although slightly diluted to what they were in the early part of 2025, with changes in global trade, generally speaking, changes in global supply. It'll be interesting to see how these come up, and with obviously a disparity in likely central bank action, then it may be interesting in terms of how all of that influences forward guidance. So that'll be watched really closely. And then, of course, there's the first reporters in each sector. So, for example, Delta Airlines are usually the first airline to report, and often the day before JPM. I can check that out. It's usually the day before, or actually 13th of Jan. Actually, okay, that's so next week. So that's the first airline to report. Now, what I mean by the first reporters is that people will look at Delta's numbers and make inferences about what this may mean for other airlines. So you'll get a response to Delta, only a response in Deltas, but also LUV, will respond as well to that. So watch for the first reporter in every sector. If you are, particularly obviously, if you are investing in US share CFDs, and of course, your key thing is to find out when anything you're holding or anything you're thinking of getting into is to obviously be aware of what the earnings date is and balance the risk of possibly the most risky time for stocks is actual earnings report date. And ASX earnings will kick off in usually February. Rob says, is there any chance because of nothing Venezuela isn't the challenge to do the same time? Well, I don't think so. But interesting. Great comment. So where are you going to plant your flag, Mike? So okay, so I'm planting my flag in a positive earnings season again. I don't think it'll be as good as last time. I think we'll sort of see well into the 70s possibly. Let's plant my flag in 75% of the EPS expectations. I think revenues may suffer a little bit, but I still see it in the 60s beating expectations, sort of low to mid 60s. So there you go. That's what I think may happen. And of course, it's May and it's Mike's opinion, and not one that um, you should make your own decisions on what you think, based on what we've talked about here today and the other stuff that's coming across. Okay, so let's look at metals. We've already checked out gold, but we've seen sort of the buying into gold on safe haven demand, geopolitical uncertainties, and the inflation dynamics, as I've explained. It's really inflation to rates, to USD, and then the influence from USD. So the expectation is that current inflation figures don't support a cut in January and may only partially support a cut in March. That means USD is not likely, even if it might be supported by some uncertainty and the prospect of potential rate cuts later in the year, that support is fragile potentially. Again, if we sort of look at the US dollar daily, we've seen a little bit of pickup on the back of that sort of risk, that geopolitical risk, but we are in a range. Should we get a breach out of this range, that may result in a short-term pullback in gold. But just for context, again, I'll just put this on a long-term picture so you can see where gold is. Where the USD is. These lows that we hit in September 24, and they are essentially what markets are looking at. And this is the US dollar index, of course, which is based on a basket of shares. So is a reflection of general USD performance, not specific US performance against specific currencies. We're seeing some currencies that are doing particularly well, like the Australian dollar, for example. But with currencies, you've always got to see it in context. It's not just essentially one currency, it's the other. But in terms of metals, the US dollar index is a good gauge. So the USD outlook isn't particularly positive going forward compared to some other economies. If the likely direction of the Fed is down and the likely direction of Japan is up, then generally speaking, that obviously doesn't support strong USD unless there's a change in either side. So if we look at those record highs in gold are very much in the crosshairs, despite the fact we've got a little bit of a pullback today. It'd be interesting to see how it closes in the morning. And then if we see here, if we look at gold, see the probability is sort of mixed in terms of what might happen next on a daily chart. But if we look at the hour 30-minute chart, as an example, you can see here that we've got a bounce off the lows of the session, which is really not surpassed. The lows didn't surpass yesterday's lows. So we've got a key level in the short term of around about 444.76. The last few hours, certainly since the European session opened, has seen us move generally higher. So this could feel a little bit of profit taken on the back of this strong move here. That was an interesting retracement we saw, but that essentially has been almost removed completely. So this move through here, if we get a close that's above this key level here at 44.76, and not that far away, or even challenges yesterday's high, then it looks sort of that, which is at 4,500, another psychological key level. Then if we breach 4,500, we could see that that may sort of result in further buyers coming into the market, with the player pushing it up to record highs again. So interesting dynamic on that. But Most of the signals, so fairly significant conflict globally and uncertainty geopolitically, combined with an overall weakness in USD, not only for right now, but what might happen next, is supportive of precious metals. And of course, silver. Silver shot through the. Let's just put silver on like this chart here. You'll see silver's done particularly well as well. So there you go. There's silver weekly. Absolutely smashed it out of the ballpark. You can see today we had a little bit of a profit taken, a little bit of retracement here. Again, a new high yesterday. Context. There we go. There's your context. So we're looking for yesterday's high. A very similar pattern in silver as there is in gold. Not quite the buoyancy in that. I'm thinking maybe looking at that chart and gold, that silver may be a follower rather than a leader, as is often the case. But certainly, we've had a standard technical picture here. Come back and retested a key level that was resistance, is now acting as support. We've had a 3-week test. We've had another test in the last hour, but we appear to be bouncing off that again. The key level for silver in the short term is probably around here. You can see that was support here, that was resistance there, and this is at the 79.30, sorry, 79, let's call it $80. Nice round number again. Market likes nice round numbers. Good day, David. As for the metal sector, somewhat surprisingly, we saw a massive surge in copper since the turn of the year. Let's look at a copper chart. Softer today, but this is on the back of a significant run. So you can see the softness today, which looks as though it might have leveled out with the support short term of 596. But the important picture is this: record highs this week. So we tested that a couple of weeks ago, this level here at 585, and breached that during the course of this week. 2 very, very strong days. Now, this was intraday highs here on the 24th of July. And this was obviously pre-Trump's 50% import tariff into the US. So it's completely obliterated all of that. I've been talking copper really for the last month. You can see that breach there, taking it up, and a test of $6, one of those nice round numbers, a little bit of a pullback, but again, you can see it's hardly convincing. At this stage, we've got back about 50% from the lows of the day. So we are in less than a cent short of $6. So a breach of that could see us retest this high at 606. And again, a breach of that could be very bullish. Of course, with any of these where there's a resistance level under pressure, then it's called a resistance for a reason. So there is a fairly reasonable chance, as you saw on other charts, that the probability of the next move could be either way, really. It just depends on what news comes over next. And there's a couple of interesting points to talk about in a moment. Copper supported by increased narrative again about China stimulus, and the physical demand for copper is still relatively good, with the obvious exception of the US, with still a drive to put in energy sources which are renewable and non-carbon orientated. So that's why copper's where it is now. Obviously, rare earths and critical metals have been in and out of the headlines over the last 3 months. It was a big bone of contention between the US and China, and China obviously process 90% of the world's rare earths. So it's a big trump card, if you give the slight pun, that China have over the US. And obviously one of the reasons that the US is looking at other places, it's theorized that part of the attraction may be looking at where rare earths may be, so they're not sort of become less reliant on China. Apologies for the spelling mistake, but also lithium's on a little bit of a tear to the upside, which has sort of been interesting. Let's just have a look at a couple of charts. Now, a chart that I've been liking for some time is REMX, which is the US ETF. We were talking about it at this point here, with the potential move up to this level here. Rare earths had a storming last year. If you look here on the chart, you can see really since April that the surge in this has been spectacular. That's over 2.5 times growth. Now, there may be, just put this here, there may be a pause point here, but we've certainly breached these highs here. We have a period of consolidation supported by the 200 MA on the weekly chart. Around about this 75 level, we were thinking that a breach of 75 might be significant, and it actually has been. Not only taking us past this record, past this level we haven't seen for well over 12 months, but also pushing through that sort of intra-week high and eyeing this higher level again, which is around about another 4% to the upside. So good move on REMX. Has done what it said on the can in terms of what it might do technically or after this ascending triangle. And the breach of that looks technically significant. So this is the next level to keep an eye on. If you're not in this already, perhaps this is the level to wait for. Risk to potential upside is always something you should consider. And looking at that chart, the natural position to put a stop here would be below this last level here. It may come down and retest that, should there be some selling. So if you were to position this accordingly, then it would be around 80.52. So if we look at this from where it is right now to, let's say, there, it's about 4.5% to around about 3.5% upside. So less than a 1-to-1 risk reward in terms of where it's sitting right now technically. That doesn't look attractive to me from a personal point of view. It's always a calculation you should look at. What is the likely upside of this technically versus what is the likely downside? And you can make a judgment on there in terms of which ratio is right for you. Which may change depending on the asset you're looking at, of course, but that's the sort of stuff that is worthwhile feeding into your decision making. The other thing to say is that, generally speaking, as you can see from there, the general perception is up. If we look at some lithium stocks, let's look at Australia for this. If we look at PLS, which had a little bit of a softer day today, but you can see PLS now is trading at highs not seen since mid-2023. So is that July 2023? Late July, early August 2023, and you can see the surge in PLS, which has been evident this week. As soon as we breached this key level here, which again, it was one that we talked about in one of the live updates, then it looked interesting. We had a retest of that level before it subsequently went higher. a day to day where we saw, and this is sort of the picture that I'm looking at for gold, for an example, where although we do get this was a red candle in the early part of the trading session, but recovered subsequently. Are we going to see the same sort of picture in gold? That's what to keep an eye on. I like PLS because they're quite strong fundamentally compared to the lithium companies. But if we look at what's the right one? LTR, another one that's doing well, and this even had a good day at the office as well. So this Liontown have done exceptionally well, and now we're at levels again not seen since lithium started to drop off in 2023. If we look at, let's just bring up a lithium chart, although it isn't a tradable commodity in the same way as others. Lithium's obviously bought and sold. So there you see a lithium chart. Well, you don't. There you see a lithium chart. Let's just do, change the chart. What a nuisance. Okay. Change the way they work. The source. As you can see here over the last year, it's had a significant surge. If we go back 5 years, you can see the significant drop that there was through 2023, which is why we saw a lot of lithium stocks get battered. This is on the back of a surge in EV sales. And you can see here that the surge up really in the last 3 or 4 months has been significant in terms of pricing. So that's why lithium stocks are doing well. So there's evidence of some supply increase, some demand increase versus supply availability. So yeah, lithium stocks look like a reasonable place to be. We can see that. If we look at the ASX scanner, it's a little with mine. Then if we look at mineral resources, also good. We can open a chart. There you go. Mineral resources looking very good to go. That's the FX scanner. Apologies for that. Also, iron ore is doing pretty well as well. If we look at CIA as an example, we're seeing highs here. Not seen since mid last year. If we even look at the big boys, Rio was rocking earlier in the week. BHP are looking strong. You can see there's BHP. Again, strongest that it's been since back here in early 2024. So iron ore and neither which are tradable entities, although you can get ETFs which hold these. Let me just check an iron ore prices very quickly. So you can see iron ore prices, generally speaking, have been moving higher since June. So for the last 6 months, I've seen them not breaking records right now. And about a third of a percent in a week, but certainly the trajectory is upwards. But obviously, from a there's currency plays within here. If you're looking at things that are trading USD, let me show you what the Aussie dollar's doing. We didn't do that, but it doesn't merit. A quick look. Here's the Aussie yen, and this is under the umbrella, of course. So highs not seen since July last year. If we look at Aussie USD, again, same story. We need to go back to September 2024. So you're a year and 3 or 4 months to see levels at this stage. And this is due to the disparity, as I said before, about central bank expectations. At best, the RBA will pause its thought, and it's expected that there'll be 2 rate cuts in the US. So there you see it in all its glory. So this is that interplay I was talking about right at the start, the interplay of US yields based on US decision making, but they are in isolation. So that compares against other central bank action, which creates the flex price, which impacts on the US dollar index, which impacts subsequently on commodity pricing. I hope that sort of helps just put the picture together a little bit. So bullish tilt continues in particularly lithium and rare earths, I would suggest. So having looked at the picture, I hope that's been interesting and useful. Let's just sort of try to summarize that. Venezuela remains a geopolitical flashpoint. Short-term effects on all are limited, but really I think that the major issue is what happens next geopolitically across the globe. It's very hard for the US, or it's very disingenuous for the US. Some would suggest that they will criticize China eyeing Taiwan when they'll do this to Venezuela, potentially Colombia, etc., etc. Canada even. Earnings growth has provided market support to date, but valuations will require some scrutiny, depending, I would suggest, particularly on forward guidance. There is an undoubted risk in earnings, as there always is, not only to individual stocks, but companies as a whole. It's one of the reasons why ETFs may not be a bad thing to look at. Watch that first reporter, I would suggest. So equities are high, but obviously we're still getting leaders in terms of sectors. We've had intermittent sector rotation, but still the leaders of the market remain the leaders of the market. Be interesting to see whether we get any re-emergence of sector rotation, particularly out of tech, into other stocks subsequent to earnings. There is the perception that there is a reasonable amount of cash sitting on sidelines at the moment from institutions. So again, that's really hard to measure or be completely objective about, but that's the narrative that's been pushed by markets. That may again help in terms of keeping equities at high levels should earnings season be a positive one. Metals are strong, both currently on safe haven issues and industrial demand. And most of the fundamentals seem at this stage to be supportive of more upside in metals, both precious and base metals through Q1 at this stage. So again, to be balanced, any changes in global trade and central bank policy will influence that significantly. So there you go. There's my little meander around. If there's anything you'd like me to look at that I haven't already, then let me know. Cryptos, yeah, we'll have cryptos have been an interesting place to be. We had this 36% drop in Bitcoin through November, or between October and the end of November. Since then, we've been in a range. We looked as though we might tackle the top side of that range a couple of days ago, as you can see. The high wicks we hit here back on the 9th of December were tested, but then we sort of saw it back into the range again. So it doesn't suggest the buyers are there in strength at this stage with cryptos. Euro USD would leave alone. Now, in terms of data tonight, we've obviously got the ADP jobs report. I didn't reference that. It's jobs week. We've got ADP jobs. We've got weekly employment. We've got non-farm payroll on Friday. Watch also for the PMI numbers, the expectation expectation is there won't be much. Oh, that's interesting. The CPI is, I didn't realize it was so close. Maybe we'll just hang around for a minute or so to see what that CPI number comes in like. It is expected to remain fairly static. Also, because it's Wednesday, watch the crude oil inventories. They there is expected to be a lesser drawdown in those, which if that happens, or if there's an even lesser drawdown still, if there's a build, then that may be enough just to put oil down again. As I said, if we look at the 13th, it is the 13th, which is CPI. PPI on the 14th, and obviously there's inferences from PPI that's made to CPI. But really, Friday is under scrutiny for consumer sentiment, as well as non-farm payrolls coming out. So that's really, obviously, a key data point. We've got weekly jobs coming out of the US tomorrow. Right, there we go. We got a 2.3 flash estimate, which is lower than expected. Year-on-year headline number, which isn't the core number. Core usually excludes food and energy. So outside of food and energy, we've got an as expected, but lower than last month. So interesting to see. Let's just have a quick look at the response of the euro. Maybe look at the euro USD, euro yen perhaps. So virtually no even flinch, not even a flinch. Euro USD, the current picture remains. We've got a short-term support and very short-term. I'm starting to get a market flicker now. Hardly. This looks like a trap to me. Those are your two key levels on the euro. I don't think that's even worth looking at. 116.86, 116.91, 5 pips. I wouldn't get interested in the the euro USD unless we had a breach of this level to the upside. Which is sitting at 117 and entered the downside at around like this 116.73. Looks so that's done nothing. We may get more movement on the ADP report tonight. Cool. Right. Well, I hope that's been interesting, useful, giving you some things to think about and keep an eye on. In terms of what might happen in January, I think we're going to have periodic volatility on the back of events. But generally speaking, I think the market's going to lack a little direction unless there's a significant event. Watch metals, watch equities, obviously, once earnings season kicks off next week. But I would say there's equal headwinds and tailwinds kicking around at this stage. So it may not be the easiest month to make longer term decisions is I guess the message. But it certainly makes sense to keep an eye on things. Of course, you can be able to keep an eye on things here and on the live updates that we run on Monday and Thursday. If you're not part of the Thursday thing, I'll give you the link to that. That's usually a lunchtime event. Same with Monday. Just give you a link. Watch it on YouTube, or you can do the GoToWebinar thing. There we go. Let's put it in here. You'll see that in chat now. So obviously you've got to focus on your right now actions consistent with your own personal situation and your trading objectives. That should be your next thing. How am I going to, one of the purposes of sessions like this is, what does this mean for how I'm going to behave in markets going forward? So the process should be, you go back and check in on some of the things that I've said, make your own decisions about what this means to the way you trade, stroke invest, and obviously create a plan of action. I often promote the idea of a daily agenda where you would have a look at things, get that market overview, and make yourself what's coming at the start of your trading day. There's no logically it would be prudent to potentially do that for the week ahead, and arguably for the month ahead. Um, which is an interesting concept. Not one I've ever promoted a month ahead. I've certainly done a week ahead before, but maybe this is a sort of month where looking at what's going on in the month and the ups and downs, headwinds, tailwinds, pressures and supporters are all worth bearing in mind without scaring yourself. Having a plan as to what does this mean to the assets I might invest in, time and when in which I'm going to do it, the outlook that or the trade duration that I'm looking at. Am I looking for a long-term trade because I think Tesla's going to be great or Nvidia is going to be great? Or am I looking at a short-term kill on the back of an event? But always, of course, always make sure that you have the appropriate risk management in place, not only to manage capital risk if things go, if that idea doesn't work out, but also to lock in profits and reduce profit risk if something does go in your favor. Thank you very much, everybody. Some of your comments are wonderful. Thank you. It's always really appreciated. You're welcome, Rodney. Cheers, David. Thanks, Simon. Thanks for everybody who participated as well tonight with some of your questions and comments, and Brian and Alyssa and Sonia and Rob. Thank you all. You guys take care, trade safe, and I will see you again very soon. Thank you very much. Bye-bye for now.